Hey y'all, it is Ashley and Bill, and we have some more money talk for you. Bill, how are you today?
Doing fantastic. How are you doing, Ashley?
I'm great, man. So, to recap, I'm a real estate expert. Bill is a money expert. And each week we get together to bring you just some general info around the home buying process, terms, demystifying, debunking some things. So, today, I think we're going to talk about a term that I, as a real estate agent, keep hearing over and over again. I'm hearing 2-1 buy down, 3-2-1 buy down. Bill,
Yes.
what is this 3-2-1 ready, set, go stuff?
Yes, absolutely. Well, let me ask you this: since you've got quite a few houses that you've had listed, how um, how doable is it for getting some seller concessions from sellers nowadays?
Oh my gosh, we are in a whole new world. So if you guys are watching this sometime way into the future, it could be different. But as of October 2023, it is a buyer's ball game for sure.
Good. So why I asked that question is because there's money on the table for buyers now,
Mhm.
and what to do with that money is always something that comes up. And with the market how it is and where rates are now, is there's just good programs out there to help make it feel closer to that COVID era of where payments can potentially be for someone. Hey, I missed out, but I still want low payments. So there's options for them to make them feel a little bit better of what their monthly payments could look like. So to start, the best thing is permanent buy down versus temporary buy down. So permanent buy down is where someone can use this seller help and use these monies to permanently buy their rate down. So I'll try to keep it in layman's terms here, but when you are buying a house, there's not just one rate out there. There's several different rates that you can kind of look at or see or use for your house purchase. We like to call in the mortgage market a par rate, meaning the rate that costs no money to someone. And we'll use
Okay.
that like an 8% rate because that's kind of where rates are been hovering lately. So we've got this par rate. So let's say, hey, I want to use this money to buy down my rate. So what does that mean? Well, it means that we can get that rate lower. So it might be 7.5%. What does it look like to get to 7%? And we would use these monies to try to purchase power to get down there. So what that means is you're using all your sellers' help. We're getting the rate down lower to whatever that is for you. Um, the downfall in this play is when we do permanent buy downs in the mortgage market is we try to do a compare of what we call your break even point. So if I've got an 8% rate and I've got a 7.5% rate, the mortgage payment's different, obviously. So the cost of that rate is, the cost to get that rate to 7.5. We look at how many mortgage payments do you need to make the difference up in the cost of that rate that we just paid to get that rate down. So we call it the break even point. And I'll just tell you, an average is maybe 4 to 5 years to get that money back from a buy down, permanent buy down to there. So it's like,
Okay.
well, we're going to refinance probably in 3 years or so. Doesn't really make sense for a permanent buy down. So we got this crate program called a 2-1 buy down, a 3-2-1 buy down, or excuse me, they call it temporary buy down. What this means is instead of using that money to buy a permanent buy down for the rate, we're using this to what we call do a temporary buy down. So we're going to use 8% because that's just a good round number. We locked in
It
buyer
doesn't
here
feel
for
good, Bill. That number
what's that?
doesn't feel good, by the way.
But that's
To
where
make
we're
it
going to get to. And
better.
this is how we're going to try to make it feel better. So we got an 8% rate here. And we're going to do a 2-1 buy down here. So based on $500,000 loan amount, we're going to need to ask money from the seller. And I say, why the seller? Is the only way these work is the money has to come from the seller. So
Okay.
using these seller concessions is we're going to take this money and we're going to keep it in kind of what we call like an escrow account. Very similar. It sits there with the loan servicer that's servicing the loan. So you have this 8% rate. So 2-1 buy down means the first year your rate's going to be based on 2 points lower. So your payment will be based on 6% instead of 8%.
Okay.
So what that means is again is It's not permanently, but the first year, all your payments are based on 6%. This would be about $800, give or take, less than a monthly payment. So the difference is made up with that temporary buy down money that the seller provided. So for the full year, you're making a payment based on 6%. Year two, we get to 7%. That goes the two, now the one part of the buy down, and we're at 7%. This brings it down to probably $400 or so less of that 8% rate that we locked into. And then if we get to year three, we get to that rate we locked in at 8%. That's why we call it a temporary buy down, because you're never really permanently buying the rate down. You're always locked in at that rate. And why do I say if you get to year three? We're in this market where, listen, it might be a year and a half, might be 2 years where rates will come down. They will. They always do. So when rates come down, guess what? We're going to refinance. All right. We're going to get you into a lower rate so you never see that 8% rate.
Mm.
So what if I refinance in my temporary buy down after, let's just say after a year? I used all this money to help from the seller. Where does that money go? Well, the good thing is it goes back to you. So we refinance all the money that was provided for that seller help, the seller concession, to get to this 2-1 buy down, goes straight back to you. They do a principal reduction. So it goes straight to your principal and you never lose that money. Permanent buy down, once you do a permanent buy down, money's gone. You refinance, you don't see it back ever again.
Okay,
So
so
that's
let me
why,
make sure I understand. So let's say a seller is going to give the buyer $15,000 in a
yes,
concession to apply towards this 2-1 or 3-2-1 buy down. And in year two, rates are very attractive at 5% again. And the buyer decides to refinance and take advantage of that. So whatever money is left over, let's say it's half for easy math sake,
okay,
$7,500, that's applied as a principal payment to the loan. Is that right?
correct. Absolutely. So it's just called a principal reduction. It goes straight off your principal. Again, that money's yours. So it comes back to you. Unfortunately, they don't give it back to you in cash, but it does, like you said, get to a principal reduction. So you take advantage of a new rate, a lower payment, permanent lower payment, and you get to keep those monies. Where, again, permanent buy down, you don't get to see it again. So that's where it's so enticing in today's market to use seller help, because it's out there. I think it's available for a lot of people to try these buy downs. These temporary buy downs, because it just benefits you more than trying to permanently get your rate down to something that maybe on paper looks better.
I love it. I don't know how you did it, but you made 8% suddenly feel great. Thank you, Bill.
I know nothing feels good about 8, but there is good stuff coming down the road. So we got to be positive, but good deals to be had, right, from your side.
Oh, absolutely. In my world, I'm seeing this as such amazing leverage for buyers who want to get out there and shop, because the reality is when those rates do get below 6, we see 5s again. It's going to be that frenzy that people were experiencing in 2021, early 2022. And who wants that frenzy? I mean, you can powerfully shop and not have to compete and take your pick of the best houses. So that's really fantastic.
Yes, you hit the word on the head with compete. You don't want to be competing against a bunch of people like we were a couple years ago.
Nope, sure don't, because then you're going to have to pay over asking, and that's just your money out of pocket, not the other way around.
Absolutely. Absolutely.
Awesome. Well, Bill, thank you so much. That was another mortgage moment. More to come next week. So stay tuned and we'll see you soon.
Thanks, everyone.